The pendulum is certainly swinging back. Why Amazon plans to spend $1 billion making movies for theatrical releases. And this has been a big storyline that has really impacted theater stocks to the upside, because what is the biggest problem that theaters face? It's not people that don't want to go to theaters. They're not trying to attract new people, more or less. They just need movies that go to theaters that aren't released on Disney Plus or Netflix or these other streaming sites on the same day. They need theatrical releases, and that is one thing that has really been a lacking factor of the last 2 years with movies, not only because a lot of them were delayed because of COVID, but just a lot of theaters opted to invest in their own streaming platforms and leave the theaters behind. But that is obviously a very bad mistake given the blockbuster films that we have seen over the past year or so. Top Gun Maverick, you had the Marvel films that have came out. You have had Black Panther Wakanda that just came out that is doing great numbers. Spider-Man, Marvel, right? Doing insane numbers. And you were going to have Avatar 2 with a $1 billion budget alone that is expected, or $2 billion budget alone that is expected to do billions of dollars at the theaters, guys. So we're going to dive into exactly what this article says. We're going to look at the data behind AMC, literally all of the data. Take a look at the technicals and where this rally could go in this next upcoming week, guys. So do me one quick favor. Make your way down to the bottom of this video and click that gray like button, turn that baby blue, and let's get straight into it. So I just read the title of this article, so we're going to dive straight into what is said. So Amazon is betting big on the theatrical experience. The tech giant plans to invest $1 billion to produce 12 to 15 movies a year exclusively for theaters, according to a new report from Bloomberg. That spending would be roughly on par with major film studios like Paramount Pictures and Bloomberg reported. And this obviously made AMC, Cinemark, and IMAX stocks go up in a big way. Earlier this year, Amazon closed its $8.5 billion deal to acquire MGM. So there is going to be a lot of hype over this, when movies could be coming to theaters. And like this analyst says, Sean Robbins, that it might actually start to fill some of the gaps in the theater movie slate, right? Because a lot of blockbuster films, yes, they come out this time of the year. There's not too many in the spring. End of summer tends to be a decent time as well for movies. But really, that late winter / early spring time period is not a big movie theatrical release kind of time frame, right? You don't get a lot of blockbusters that go to theaters during that time. If they can help to kind of fill the gap and fill the void there, that could be very big fundamentally for movie theaters. And that is why these stocks really have been making their way higher. But AMC is in a whole new category of itself. I mean, this stock is looking primed for a rally to the upside. Typically, you do not find this much support at the 50-day moving average until you do get that big rally, but AMC is really trying to make a move higher. After we have gotten that news, it's been pretty bullish, and we are now getting away from the 50-day moving average ever so slightly, and we are going to make that test of the 100 and 200-day moving averages probably early this next week. And the 100-day moving average is at $8.69. The 200-day moving average is at $9.21 per share. And just simply put, looking at this, I want to be long on AMC above the 50-day moving average. I've said this many times. I want to be long on it in options. I want to be long on it with as much upside exposure as I can, the longer we stay above the 50-day moving average. If we break out above the 100 and 200-day moving average as well, that will be very good. And typically that does happen with AMC's rallies. After it holds the 50-day, typically you go straight to the 100 and then the 200-day moving average shortly after that. But before, these moving averages have been pretty substantially above the 50-day moving average, right? Back here in March, I mean, the 50-day moving average was at $10.50 per share. The 200-day moving average was at almost $21 per share. There's been a big gap. Now they're a lot closer. So I do think if you do get that break, you could see something along the lines of August where you broke the 200-day moving average and you still continued almost 100% higher after that, and that would put AMC firmly in the double-digit ranges. So that's kind of my expectations for this upcoming week, is that we'll probably break out above these key moving averages. I want to watch this down trending level of resistance, this line right here, to see how we, kind of hold up or even, get rejected around there, which would be about $10.50 per share. If we continue above that, next stop is going to be about $12.50 per share. And I think this could happen very explosively. I think it could happen with very short notice. As you guys can see, volume on Friday, granted, it was a half day and it was the day after Thanksgiving, was only about 8.3 million shares that traded hands on AMC. Slightly red day, down about 1.70%. But nonetheless, the fact that you are not cratering on low volume like we have seen throughout 2022 so far was a very positive thing on Friday. And the question is, how much volume is going to head into the stock? Really, that's the biggest question. If we can get volume that really comes into the stock, we can get those options traders to continue to flood into those weekly options, which I'm not endorsing you guys do by any means, but people just do it. If that continues to happen like we've seen over the past 2 weeks now, it will drive AMC stock up higher, and you will want to be long on this equity. Now, if we take a look at the Ortex data, we can see 20.03% short interest of free float is where we are currently sitting at. The amount of shares sold short sits at 103.27 million. The cost to borrow numbers are very impressive. Cost to borrow, the live numbers that were people were taking out short positions on AMC on Friday, sitting at 43.71%. This cost borrow number is helping to squeeze shorts out of their positions, with the stock doing very little, because a lot of these short positions, these loans, are on adjustable rate bases. So when you're getting an adjustable rate that used to be 10 to 20%, now it's double that, 43, 44, 45, even as high as 90% last week. That does play a big role in the interest payments that you're going to have to pay and the risk to reward proposition of shorting AMC. Because, essentially a lot of these loans, like I said, are variable rate. They're kind of like an adjustable rate mortgage, right? Because they're so risky. It's very risky to short stocks. Stocks can only go to zero. They can go to infinity, right? We've seen that happen before. It's risky to short AMC. So these loans on adjustable rate bases. Well, if you're looking out in AMC and you're saying, hey, what's this picture going to look like fundamentally 6 to 12 months down the line? Is it going to be better or worse than it currently is today? I think the overwhelming consensus is it will be a lot better. Maybe the market environment will be a lot better as well. And that's a recipe for disaster with hedge funds with short positions. Unfortunately, a lot of these short positions are probably done with trading algorithms, not necessarily humans making those decisions, and that could also work to our benefit once a short squeeze does happen, because that's when these algorithms would cover on their short positions, but they're probably not going to do so until they absolutely need to, right? So as we're seeing, the cost to borrow average is sitting at 55.14%, cost to borrow max at 64.17%, and cost to borrow minimum sitting at about 7%. Obviously, we know these numbers are a lot higher. Just on Friday, the actual cost to borrow minimum was at about 45%, which is more in line with the live numbers that we were actually seeing. Now, as far as option activity over the past week, 62 orders totaling $2.55 million, positive order value of 33%. On Friday, 10 orders totaling $310,000. Positive order value of 42%. Yes, it was a holiday week last week. It was pretty slow. You had the half day. We were closed for trading on Thursday. So it makes sense why the option activity was a lot lower last week. And I do expect that to pick up in this next upcoming week. And we can see with the Stonko tracker data, I don't expect anything too crazy. There's not a lot of option activity for the next 2 weeks. And this is not updating right. I don't know why it's not registering these numbers, but the next big option expiration is going to be December 16th, and last we knew we were sitting at about 130,000 calls that were out of the money and about 15,000 that were in the money. Now it's just giving you a bunch of zeros across the board. This is obviously not accurate information, but around December 16th, that's going to be roughly 2 weeks, 3 trading weeks away from where we currently are. That's where things could, in my opinion, get a little bit more explosive, especially as you do start to see a lot of those FTDs, those 35 day, right, those delays, T plus 35 delays starting to actually be reflected in buy orders, with those FTDs being forced to cover. Nonetheless, it's looking pretty exciting, guys. But the long story short is I want to be bullish above the 50-day moving average. If we break under that 50-day moving average, I would want to cut losses on any option positions that I have. As you guys know, I've been long on this stock the whole entire time throughout all the ups and downs. I just think there is at least one big rally left in the tank, and I think it will likely be bigger than even the June rally, especially as the fundamental picture has vastly improved for AMC. Now, in the week ahead, you guys really want to watch TLT. This is the 20-year bond. You want to see where bond yields are going. When this chart is rising, that means bond yields are falling, and that is exactly what has been happening ever since this really bear market rally started to form. You can see we've started to create this uptrend. I wouldn't be fooled. Bond yields are probably going higher again at one point, but for now, if this chart continues to move to the upside, that's going to be a very bullish factor for the markets. At the same time as the dollar continues to fall, that's going to be a very bullish thing fundamentally, and that will help to drive up valuations, thus driving up the stock market. But we do have a lot of data in this next upcoming week that will also move the markets in a big way, that could really help to push us to that next level with this bear market rally, or it could push us down to the downside in a pretty big way. So you have the ADP employment change for November coming out at 8:15 in the morning on Wednesday. Monday and Tuesday don't really have a lot of data, so we're just going to skip those days, but Thursday starts a lot of the data. Now, at 10 a.m., you have JOLTS job openings for October. We are expecting 10.4 million job openings. The last reading we got was 10.71 million job openings. So we are expecting a decline of about 300,000 job openings. I think that's reasonable. I don't know what's going to happen, so keep that in mind. But as you guys know, a lower number is going to be better. A higher number is going to be very negative for the markets, and the markets are going to be very sensitive to economic data right now. So each of these data points will be very, very important. Now, personal spending month over month for October, we are expecting 0.4%. The consensus is about 0.7%, and the previous reading was 0.6%. So it came in better than, or worse than expected, which was better than expected for the markets last time around. Same thing for personal income month over month as well. We are expecting 0.3%. Consensus was 0.4% last month, and it came out as 0.4%. So we're expecting personal income to go down as well. ISM manufacturing PMI, the forecast is for 50. Consensus last month was for 50, and we came in at 50.2. So slightly better than expected, meaning it was slightly worse for the markets than what it could have been. Now, the big data point is going to be on Friday, and you have the unemployment rate for November. This is going to be the big catalyst for this next upcoming week. Forecast for 3.7% unemployment. The previous reading was 3.7%. The consensus was 3.8%. So that's what helped cause a lot of this bullishness in the markets, was the unemployment rate didn't go down in a big way, and that's kind of good and bad. On the recession front, that's good. On the front of getting inflation down, that's not necessarily a good thing. But the overall trend has been, throughout 2022, the unemployment rate continues to go down. So the fact it stopped going down as fast as what it could have been, that was seen as a bullish thing. And we are still expecting a 3.7% unemployment rate. I think there's a lot greater chance this actually comes in higher than 3.7. So if that does happen, that's going to be insanely bullish for the markets. Now, what we are seeing from the non-farm payrolls for November as well. Last month was 261,000 jobs. Consensus for this month is 200,000 jobs, or last month was 200,000 jobs, and the forecast for this month is 210,000 jobs. So if that can come down in a big way, that would also be very, very bullish for the markets. Nonetheless, that is this week in a nutshell, what to expect. That's kind of the data behind AMC, what I am personally looking at. I think a lot of this rally does come down to the technicals above or below the 50-day moving average, guys. So that is it for this video. Thank you for watching. Hit that like button, subscribe to the channel if you guys have not already. Get your free stock down below in the description of this video, and if you guys want to come trade with me live in real time, link down below in the description of this video as well. You guys enjoy the rest of your weekends, and I will see you in the next one.